Welcome to our investment series where we're going to break down some jargon and some complexities from the investment industry, and we are going to distill some of these principles in practical examples. Please follow us for this series. I'm sure you're going to enjoy it. Hi, I'm Jan Botha, Wealth Manager at PSG Wealth R21. Today, I would like to discuss with you what is the difference between contributions and growth within your investment portfolio. There is a distinct difference. A common mistake is that we tend to mingle these two principles with each other. By illustrating this component, I would like to refer you to a schematic picture where we're going to illustrate these two dynamics. With reference to the chart, the darker color represents the contribution that the member has made over time, and the lighter shaded color refers to the market growth that has been achieved in that particular investment portfolio. Very simple, using an example, a client starts to save 2,000 Rand a month in his pension fund. He will get 10% a year over the long term, and he would be able to increase his contribution by approximately 6% a year. So let's see what happens over time. As you can see on the slide, your total contributions increase over time, as well as market growth is starting to add additional value in his investment portfolio. But what could be quite discouraging is, if you look at year 12, year 13, approximately half of the value in his pension fund or investment portfolio is actually his own money, the contributions that he has made, and then the balance is market growth. Now, someone might perceive this as, I've been in the market for about 10 years and the majority of the capital is my contributions. But as we go through time, the contribution factor or the contribution level in your pension fund starts to get smaller and smaller, and market growth is adding much more value in your investment portfolio. That is the dynamic, what we refer to as compound growth over time. Unfortunately, and in reality, what we see is that at year 10 or 12, a member might resign from his pension fund, he cashes the investment in, might buy something else with the capital, and in effect, you start back at year 1. So that particular member does not really give himself adequate time for compound growth to happen over time. To put it simple, it's like a snowball that you are building and building and building, and it takes you a couple of years before this investment gains critical mass. If I'm an individual that has an investment portfolio and I haven't adequately saved for retirement, doubling or increasing your contribution significantly in that last couple of years will obviously have an effect, but you still need the compound effect, and that takes a lot of time. And the third analysis from this particular experience is that last couple of years in your retirement is crucial. That is where the bulk of your wealth will be made in your portfolio journey. So what is the summary from this particular slide? Start early, just get the discipline on a monthly basis and let it run for time, and it will work out for you. For the last 16 years, I've been guiding investors and families on their financial journey. Two things that I'm really passionate about is the financial markets, but more importantly, is to navigate my clients through the storms and turmoils that these markets do present. If you need someone to navigate you through this financial journey, please do not hesitate to reach out to me.